Good morning and welcome to Marketing Matters. I'm Sarah Touchstone, Landmark Title's social media marketing strategist and educator, bringing you Marketing Matters every Wednesday at 10 a.m. here in our Arizona area. We have a lot of great guests that come on here, and we've had the pleasure lately of having guests from some of our outlying offices where we have Landmark Title offices. We have 7 here in the Phoenix metro area, but we also have offices up in Prescott, where Jason is today, as well as Reno and Las Vegas. And we've had the pleasure of actually getting some of our partners from these areas on Marketing Matters. And like I said, Jason is one of our partners that is on today from Prescott. He's with VIP Mortgage up in the Prescott area. He works with Michelle Wells, our business development manager up there. And he's got a really great topic that he's going to be covering today. Jason, why don't you go ahead and tell us a little bit more about yourself and what you're going to be covering today?
You betcha. Thank you, Sarah, so much for having me this morning. It's a pleasure to be on with you. I'm really excited to share what it is that I have today. My background. So I've been in the mortgage industry now for over 20 years, and my way to getting to where I'm at as a branch manager, loan officer, is a little bit different than maybe most loan officers. I actually started in the back office of the mortgage company. I worked in this magical department called secondary marketing, which is just a fancy way to say we were the ones who watched the market. We would sell closed loans into the secondary marketplace. So I have a strong focus on what happens economically, how that affects interest rates, how it affects loan programs, all those different things. So my background makes it just a little bit different, for me to be able to talk about a topic like today, which is interest rates, inflation. How does that affect us in the business? What can we use based off of this information to make us better professionals for our clients? And how can we take a look and read the tea leaves, so to speak, so that we can see what's coming down the pipeline to make us a little bit more effective at our job? So that's me, that's who I am, and that's what I'm excited to talk about.
Excellent.
So I'm going to go ahead and jump right in, and I am going to share my screen over here because I got some slides. Now, I do want to go ahead and warn you a little bit. Today's presentation is going to seem pretty academic, and I kind of do that on purpose a little bit because I really want to give you an understanding of how, when you're looking at articles that you see online, when you're watching, the news, if you wanted to turn and look at Bloomberg television or any of the business channels out there, that you can spot a couple things and identify what they're actually talking about. And again, how does that apply to you in real estate? So I'm going to ask you to bear with me a little bit because we're going to take the long way to talk about where things are at. But I do very specifically want to leave you with a couple ideas about how you can put this information to work for you and your business. So I don't want to just go to school today. I want to go to school and I want to send you out with some information that could work. So to really kind of sum it up, objectively, I want to do 3 things today. I want to understand what's happening in the economy. And I'm very specifically going to talk about where, as Americans, we hold our wealth. That's very important to us in real estate because we actually are purveyors. We sell one of the 5 different classes that I'm going to go over. And then I'm going to talk very specifically about how this marketplace, which is kind of scary because if we're reading the articles that are out there, we see all different kinds of things. Here's the thing. There's lots of opportunities that are very unique to this market, and we're going to talk about those as well. So jumping right in, I do want to talk about where do we as Americans retain our wealth? And that's a very important question for us to kind of go through and talk about. And the answer to that question is we do it in one of 5 different ways. We hold our wealth in cash. So for instance, many of us, hopefully all of us, have bank accounts, and we keep a certain portion of our assets in cash. We generally have some stock holdings. So if you have a 401k, an IRA, a certain percentage of those holdings are going to be in mutual funds. Those mutual funds might have stocks that they have. You might have some Apple Computer, whatever it is. You're also going to have a portion of that portfolio in bonds. So they might be, government securities. They might be a number of different things, but at the end of the day, bonds are another place where we end up holding some of our wealth. Now, commodities, that's another place. I don't want to neglect those. Gold, many of us have invested in gold. In fact, I'm sure you probably hear some of the radio ads that are out there. The economy's uncertain, invest in gold. So that's a place that we can hold our wealth. And the fifth place, and this is where it is that we come into play, we can hold our wealth in real estate. And we do that both for primary residence purposes. We have to have a place to live, but we can also hold real estate as an investment. And there's different ways that the economy kind of affects that. And here's the underlying piece that we're really going to dive into today. The headline that we have been following essentially for the last year is what's going on with inflation. And I defined it for you. Inflation is a general sustained upward movement of prices for goods and services in an economy. Inflation occurs when there's too much money chasing too few goods. We saw a great example of what this was prior to 2022 and 2021. Housing prices were experiencing massive inflation, right? You had so many buyers that were out there and they were looking to purchase homes. There was very low inventory. So prices inflated, they rose. You have too many dollars chasing too few goods. And the problem that we have right now is inflation, economically speaking, is a problem. And this is a graph that I have here that I wanted to share with you and kind of show you just kind of the trends of where inflation was. If you take a look at that, you can go back, and see beginning in, 2021 there, how inflation almost was non-existent. And over the last year, inflation spiked almost up to 10%. We reached a high of 8.6% for inflation, which is really significant. And one of the things that it does is it forces the Federal Reserve to act. Now, there's one piece that I want to make here, and I don't have a slide for this, but I want to make sure that everybody understands the difference between mortgage interest rates and what the Federal Reserve does whenever they raise interest rates. Because a lot of times what we think is that whenever the Federal Reserve is raising interest rates, it means that mortgage interest rates are going to go up with it. That's not entirely accurate. And honestly, the reason why we think that, it's the mortgage industry's fault. Years ago, what would happen when the Federal Reserve was lowering interest rates, the mortgage industry, we couldn't wait. What we would do is we would run out and we would make advertisements and we would say, hey, the Federal Reserve just lowered interest rates. Call us and see what's going on and how much we can lower your interest rate. And the reality was, many of those times when the Fed would lower those interest rates, mortgage interest rates would actually go up. It was just a quick way for us to get applications. And so here's the way that I really want you to think about inflation. And I'm going to use a crude little demonstration here, but we're going to pretend, I'm going to grab a couple things off my desk. We're going to pretend that this piece right here that I'm going to show you, we're going to pretend that this is the Fed funds rate. Okay. This is what the Federal Reserve raises and lowers. Okay. And then we're going to pretend that this piece right here, cool little rock, we're going to pretend that this is mortgage interest rates. So a lot of people, what they think is they think that whenever the Fed raises interest rates, what they're doing is they're also raising mortgage interest rates. And it's not exactly accurate. See what this is? I hope you can see it. It's a little pad of paper.
Notebook. Yep.
This is going to represent inflation. And here's what's really kind of interesting. What happens is inflation rises, it actually forces both to act at the same time. So what happens is as inflation goes up, the Federal Reserve has to raise interest rates because they're trying to tame inflation and bring it down. And what happens at the same time is inflation is going to cause interest rates to rise. So I want you to understand, and this is important, write this down, remember this, whatever it is that you do. When it comes to mortgage interest rates, which directly affect the price of the product that you sell, unless somebody's paying cash, the causal event is not the Federal Reserve. The causal event is inflation. And that is why it is so important to understand what's going on with inflation. Okay. And we're going to talk about inflation, what that means. And I want to kind of talk about very, very quickly here how it affects all those different asset classes. I'm going to go through this super fast. If you had cash, for instance, the reason why cash is a very poor investment in time of inflation, you can see on my slide, if I had $100,000 in the bank and inflation is 8%, what does it mean? It means that my $100,000 worth of cash is only going to be worth $92,000 if the year over year inflation is 8%. So I don't have to spend money to lose value. What that's like is just imagine every single December 31st going and getting $8,000 out of your $100,000 account, going over to your fireplace and just setting it on fire and burning it. That's what inflation really does to cash. And inflation has also wreaked havoc on both the stock markets and the bond markets. So one of the things that we've seen in 2022 is we've seen none of these asset classes have performed very, very well because inflation is a drag on all of them. In fact, if you take a look, the Dow Jones, we're talking about stocks now. So we're moving out of cash, we're going over to stocks. Stocks were down across the board. The Dow Jones was down 8.8% in 2022. The S&P was down 8.78%. The NASDAQ was down a whopping 33% in 2022. What does that mean? It means if I had $100,000 that I invested in the Dow Jones, not only did I lose 8.8% in the stock, but I also lost inflation on top of that. So you're talking about a significant loss in terms of how it is that we hold our cash. So what about gold? Hey, gold is the safe investment. Let's put gold in there. Well, it certainly performed better than stocks did. The problem with gold is gold was still down 0.5% for last year. So if I had $100,000 in gold, I lost 8% to inflation and I lost 0.5% for gold. Well, yeah, I outperformed the stock market, but my asset class is still really kind of struggling there. I'm not doing very well. And here's the thing. Mortgage bonds are exactly the same problem. If I have a bond, which all a bond is basically somebody's borrowing money and they're giving me a certain rate of return for borrowing that money. So for instance, I took this snapshot. This was a while ago. This is a graph. And if you look over on the right, you've got the US Treasury. That's the 10-year Treasury. So if you were to borrow money from the government, they're going to pay you 3.635%. That sounds great. 3.63% is better than losing 8% on the stock market, but I'm still losing money to inflation. And so what happens is investors, when they look at those different things, they look at those bonds and they say, I'm not going to buy that bond at 3.63%. I'm going to demand a little bit higher rate of interest because I'm losing to inflation. And so the reason why over the last year, interest rates have gone up as significantly as they have is because bonds are responding to inflation. And that's one of the most important things that you can kind of get your arms around here. I do want to kind of tell you, everybody wants to know what's happening with those interest rates. There's different types of bonds. The mortgage interest rate market, so the clients that you sell homes to, those clients are really focusing on mortgage-backed securities. Now, you can't really see what a mortgage-backed security is trading at if you turn on the television. So what I want you guys to look at whenever you're looking in the marketplace, I want you to take a look at that 10-year Treasury. And I put a graph here just to kind of show you. If you look at these two different lines on this graph, you can see the gold line is the 30-year fixed rate mortgage, and that teal line right there are interest rates. That's the 10-year Treasury yield. So you can see how well those actually correspond with each other. So if you want to know and you don't want to rely on listening to mortgage companies advertise, because we always say the wrong thing, what you have the ability to do is take a look at that 10-year Treasury. And there's a very good likelihood that if you see that 10-year Treasury yield go up by 10 basis points, there's a very good chance that there's a corresponding increase in the mortgage interest rates at the same time. Because the way that those trade, there's a correlation there that we can see that kind of tells you where that's happening. So you have the ability now, whenever you're looking at the markets, to kind of have a good idea of what's going on with interest rates. Now, what I want to do is I kind of want to pivot a little bit. So I've set the table, kind of understand the asset classes. We kind of understand, why things are happening the way they're happening. Rates are going up because of inflation. The $1 million question for us as real estate professionals, both real estate, title, mortgage, what's going to happen to inflation? Because that's one of the most significant questions we have to ask ourselves. We want interest rates to come back down. That's going to bring affordability back to the market. So we're hoping that inflation starts to abate. So do we have reason to believe that inflation is going to come down? And I want to show you some of the data that I put together, because I think the answer to that question is yes. And then I'm going to tie all this up because it's going to tell you how to go to the marketplace and educate your clients on this information. Now, what this is a graph that I put together. And the question becomes, when is inflation going to peak? Now, the thing you have to understand is when those inflation figures come out, which they just came out yesterday, inflation was actually down again. But what we're looking at relative to inflation is we're looking at year over year trends on inflation. So what happens every single month when we go to the marketplace and we get an inflation number, what we're doing is we're replacing data from a year ago. And so it becomes very important not to just understand what inflation is doing today, but what number are we replacing from a year ago? And here's what's really interesting. If you take a look at what's happening here on this graph, I want you to notice the very first 3 months that are highlighted in gold, all the way over to the left of the screen, July, August, and September. Those were very low inflation numbers in 2021. And this last year, when inflation really started to pop, we were peaking in inflation around September and October. Why? Because we were replacing extremely low numbers on the CPI, okay? What happened when we got to fourth quarter last year? We get to October, all of a sudden, that inflation number from 2021 started to pop a little bit hotter. So we replaced a higher number. And if you look at that Freddie Mac survey, interest rates really peaked in the third quarter of last year. And over the fourth quarter of last year, those interest rates actually started to come down. And so what you really kind of understand is as we're looking at inflation, it's important to look back and see the numbers that we're replacing. And here's where it gets really, really interesting. And I have it highlighted there. I have a date that's basically highlighted in gold, and it's May 10th. I want you to remember this date. And the reason why that's so important is we're going to get April's inflation data on May 10th. And I want you to take a look here at what happens to inflation. January 0.6, February 0.5, March 0.3. But look at what happens beginning in April, May, and June, how those numbers really start to spike. So what's going to happen is as we replace some of those higher numbers from a year ago, our inflation data, which is coming down, it's going to look even better because we're going to be replacing some of those higher interest rates numbers. In other words, what I'm trying to say to you in a little bit long-winded technical way is that there's reason to be optimistic that those interest rate figures that we're taking a look at are actually going to come down. Here's another interesting piece I want to share with you, and this has to do with the shelter costs as a portion of this. Now, shelter costs represent 43% of what that inflation number is, the core CPI. And here's the problem with shelter cost as it relates to this. And this is one of the criticisms of why the CPI is a really difficult figure for us to kind of get our arms around. But it always lags, because if you think about it, when people are going and they're signing a lease, they're generally signing those leases for a year's period of time. So the data, it always lags. And so what I have here is a little graph, and it basically shows the apartment list rent year over year change. That's in purple right there. And I want you to kind of see how that number really kind of was spiking, and that number is coming down. And the shelter component, which is the other piece, you can see that's much less different. That number is what's reporting to the CPI. So here's the other piece that I'm going to suggest to you. Here's where it gets really interesting. As that shelter cost corrects itself, because I think we all can see, both experientially, anecdotally, everywhere, we can see where that shelter cost is coming down. As those numbers start to hit that CPI number, it's going to make our figures look even better. And I have one more graph over here I'll share with you guys on that to just give you an idea. Here's where it gets really, really interesting. It's the reason why, and this is not all my information. This is one of the analysts that's my favorite that I take a look at. He's called it right several times. But I want you to take a look at this, and I want you to look at the date that I have circled there, May 10th, on that deal. The top box represents the CPI, and the bottom box represents the shelter cost in the CPI. And I want you to notice that April figure, we're going to be replacing both a high number on the CPI, and we're going to be replacing a high number on the shelter cost, which again is 43% of that CPI. So what we're doing is we're looking at this and we're thinking that we're going to get a really good bump on bonds which is going to lower interest rates come March 10th when those April figures are going to be released. We just had January numbers come out. Those numbers were pretty decent. We missed expectation by a little bit. Bonds have held in there. March is going to be interesting because that CPI number that we're replacing in March is a little bit low. So that figure comes out in April. I'm not necessarily expecting interest rates are going to be great April, but I'm telling you, May 10th, and as we go into the summer, take a look at those numbers past May 10th. So the April, May, and June figures that are there, look at how high those figures are. And those are going to be the ones that we're replacing. Those are going to be the ones that we're getting to. So where does this affect us? And here is the piece that I really want to get to, because I want to tie a bow around this. And I really want to encourage you to be able to go to the marketplace and share this information. The reason why it's significant is what we understand is that supply and demand determines what price is. Okay, price is always determined by supply and demand. When we had a high amount of buyers and we had a low amount of inventory, prices were going up. There's a really good example of this. I hope some of you remember this. How many of you remember this guy right here, the Furby? Yeah, right.
Yes, absolutely.
Like Furbies, right? They were adults, they were grown-ups, right? And they were getting in fist fights in stores because they couldn't get their hands on a Furby. I could have shown a Tickle Me Elmo or something like that. Here's another one of the last couple of years that was really interesting. I have kids. Fun fact about your new friend Jason, I have 11 kids, makes me crazy. But it's all right. They're all adopted. They're from all over the world. So we have a lot of fun in our family. But my kids, they're always into the latest trends, right? They wanted an Xbox. In a couple of years, Xbox has come out. Here's what's fascinating. The retail price on that machine was about $500, but because of supply and demand, you couldn't find them. So you went to the marketplace and you were willing to pay as much as $800, $900. Some people paid as high as $1,000, for those different Xboxes. And so here's where it gets really interesting. And why am I talking about Furbies? Why am I talking about Xboxes? What does this have to do with real estate? Here's the question I want every one of you to think about right now and answer in your minds. How many of you have a client that you have talked to in the last 6 months that was interested in purchasing real estate? And that client said to you, I think I'm going to wait until interest rates come down so that it's more affordable, so that I have the ability to purchase what it is that I want. I'm willing to bet that many of you have had a conversation that's very similar to that. I have had that conversation more times than I can count. We'll qualify a client. We'll go over what's going on. We'll talk about the market. We'll talk about interest rates. And they'll say, man, that interest rate, Jason, is really high. I think I just want to wait for that interest rate to come down. And here's what it is that I want to suggest to you. Because we know what's going to happen as inflation continues to abate, we have an advantage to share with our clients what that might cost them in terms of doing that. Because what they're essentially saying is, I want to wait until interest rates come back down lower so that I can compete against other buyers who are doing the same thing. Because here's one of the problems that exists in the market right now. We are still way too low on inventory. Now, inventory is higher than it was, but inventory is still too low. And I want to show you, because at the end of the day, buying a home has to do with value. Is there value in purchasing a home today? And I want to demonstrate to you why I think it is. This is a little graph that I put together. Actually, I'm going to show you this. I'm going to do something different. Have you guys seen, can you guys see my screen? You see the spreadsheet that I have here that I pulled over? Sarah, is that
Yes,
good?
looks good.
Sarah, I'm going to ask you, you're going to help me with this.
Yes.
We're going to go ahead and build this out. Now in 2021, right, whenever the market was popping and it was hot, if you had a property that went to market and it was listed at $500,000, generally speaking, where would that property go under contract? What would you think that contract price would have been in 2021? Because it wouldn't have been $500,000. Multiple offers were bidding above. What's the number that you would use if there was a $500,000 list price?
Probably about 550. I mean, we were seeing, easily, 40, 50, even $60,000 above market.
Easily, right?
Easily.
Absolutely. Easily.
Crazy.
Fair to say we would have financed that probably around 3.5%. Is that a good bet?
Yeah, that would have been pretty good back then.
So you had a $500,000 house that was listed, you probably paid $550 for it. You were probably paying above appraised value, all those different things. Your principal and interest on that $550,000 sale price would have been $1,975.80. You with me?
Yep.
Here's what's interesting. Today, the price to list ratio on MLS is 93.5%. A house is listed for $500,000. Statistically speaking, that house is selling for $467,500, right?
Yep.
Now, I want you to help me. If we had a house today that was listed for $500,000, just came to market, what would you say that house might actually go for? Net of concessions, all those different things. What do you think that number would be if price to list is 93.5%? What's a fair number?
Well, I mean, we're seeing a lot of people getting exactly what they're asking for, but I see with where you're going is that, you know, we can probably get it for a little bit less, right?
A little bit.
So let's offer $475.
Sure. I'll tell you what, let's, why don't we do 485? Let's do 485 because the market is changing a little bit. I would agree with that.
Yep.
So here's what's really interesting. And this is what it is that I want to share with everybody. The way that I built this model, and it's dynamic, and I'm willing to share it with anybody who wants this. These boxes in yellow, all we have to do is change them to our inputs. So let's just say that we bought a house today. List price was $500,000. We picked it up for $485,000 and we financed at 7%. That's actually a little bit high because I'd rather build my models conservative, right?
Sure.
If you had the ability in 24 months to refinance that home down to 5%. Now, I don't think it's going to take 24 months because we just looked at all those different components, right? We're talking about inflation and interest rates coming down this summer, right? But again, let's just be conservative and pretend it takes 2 whole years of paying a higher interest rate of 7%. Here's what's interesting. Where is the value? Purchasing a house in 2021 or purchasing a house today? I'm going to tell you that that advantage is within $2,000 of buying it in 2021 because you're paying so much less for that home today, even though your interest expense is higher, your ability to refinance it as those interest rates abate is what's going to make up the difference in that interest rate cost. So here's what I'm telling you. Your advantage as a home buyer is just as strong today, based on the data that we're looking at, as it was in 2021. And here's the thing, I think that's a game changer for us as industry professionals. It's an absolute game changer because here's the deal. Those clients that you have that are sitting on the fence, because they're reading all of these articles. And let me tell you, the articles that they put on the internet, journalism isn't what it used to be. They get read because they put inflammatory titles, housing market crash. The market's not crashing. It's not going to crash. And everybody on this call knows it, but that's what our consumers, that's what our clients are looking at every single day. And so here's the thing, we have to educate them because what our clients are telling us when they say that they want to wait for interest rates to come down is they are telling us that they're going to wait to get into another bidding war. And I'll tell you this anecdotally, in the last 2 weeks, I've put 7 people under contract, 7 new purchase contracts in the last week. That's up. That's quite a bit for me because I wasn't doing that much fourth quarter last year. Of those 7, 3 of them I was already in multiple offer situations. And that would suggest right here, right, like going back over to our spreadsheet, if they're getting the list price, right, we might have already waited a little bit too long because the interest rates are already coming down and the market is already starting to turn around a little bit. So the longer and longer that you wait, and I'll just show you a couple different things. Let's say that price to list ratio tightens itself up. And let's say it's exactly what you say it is. List price is $500,000. It sells for $500,000. Let's say that we wait and interest rates actually are 6.5%. We cost ourselves almost $14,000 by waiting for the market not to be as soft as it has been over the last couple months. And every single month, every single week, every single day that we wait, this is what it is that we're signing ourselves up for. So as industry professionals, this is why it's so important for us to be masters of our craft. It's so important for us to understand economically what has happened, how it has created this environment, and what it's doing going forward. And so here's one of the things that I would suggest to everybody who's listening to this right now. The problem that we have so often in real estate is that we play defense. And what I mean by that is that we put ourselves out there. We go to the marketplace and say, hey, if you're looking to buy or if you're looking to sell, pick up the phone and call me. I'd love to help you. And on some basis, we're waiting for them to engage us in the marketplace. And I think this is a time that we don't have the luxury of doing that. I think that what we need to be doing is playing offense and having conversations like this with the marketplace and letting people know what's happening and where the changes are happening. Because right now, gang, it's grassroots. It's happening every single day as we speak. And if we let the news media create the narrative, if we let the analysts and the bloggers and all these people with all these inflammatory headlines control that narrative, we are not doing a service for our customers. When you take a look at Americans, the highest net worth Americans that are out there, you can always see how it is divided by people who own homes and people who don't own homes. So home ownership is one of the most important things, financially speaking, that an American can do. And the great news is that's our business. That's what it is that we have the ability to help people achieve. And so it's so important right now. It is more important than it has ever been that we understand how all of this works with the economy, to take this information to our customers and make sure that they understand what's going on. We're equipping them with the information, and then we are available to help them achieve that home ownership before these interest rates come down and we go right back to where it is that we were at. So anyways, Sarah, that's what I got. That's my presentation for today, what I wanted to share. I hope that made sense. Did it make sense? I hope so.
Excellent. Excellent. Wow. I mean, this really is great info. And Jason, I mean, I think you nailed it on the head, saying that we're back in the multiple, offer scenario. I mean, it really, it was a kind of one of those, you blinked and maybe you missed it.
Yeah.
So, I mean, here we go, and everybody's saying, the market's going to crash and whatnot. This is a strong market here. I mean, we just, had a lot of, of events and activities going on, a lot of things that are just great for our economy. Phoenix showcased itself beautifully.
Amazing, right?
Like amazing. I mean, I think, if for Phoenicians that were here, on Sunday, we're just looking around going, this is perfect. I mean, thank goodness that, we have the crazy weather this week and not last week with the open and everything. Right. But there are people that are going to keep moving to this area. And then, for you guys up in Prescott, there are people, I mean, that town has grown just so dramatically in the last, 10 years.
Oh, yes.
So just, I mean, so much. So, I mean, really, our entire state is going to continue to just grow and change. And, for people that are saying that they, have clients that want to wait, get prepared because it's coming right back.
Have you seen, let me ask you this question. I'm very interested to your answer to this. Have you seen some of those hedge funds that are coming in to the Valley and they're buying up not one or two homes, they're buying up thousands of homes? Have you seen that?
Yes. I mean, entire neighborhoods, right?
That's right. And again, they know something because this is the information that they look at. This is the information, because again, what is a hedge fund? A hedge fund is designed for people to invest their money in it and to grow their wealth. And again, we define there are 5 different ways that we manage our wealth. These hedge funds are looking at those 5 different asset categories and they're saying cash, nope. Stocks, nope. Bonds, nope. We don't want bond or we don't want gold. We're going to go invest in real estate. And again, right, that's the piece that we need to get ahead of, because now our clients aren't just competing with other clients, they're competing with hedge funds to achieve home ownership. That is how good real estate still is.
Yeah, it is. I mean, real estate it's a tangible asset So, well, things, hedge funds and, bonds and stocks go up and down. Real estate really does seem to have this, upward sloping trend. So it is. I mean, these, like you said, these hedge funds, they know that this is a great investment. They know that this is a great area to invest in. So this was awesome information, Jason. Thank you so much for coming on today. If anybody has any questions, please let us know. Brooks asked how the group can get your Excel template.
Yes. If you would like the Excel template, shoot me an email if you would, and I will go ahead and make sure that I get that to you. And what I'll do is in the chat here, I'll go ahead and put my email address right there. That's my email address. Just shoot me an email and I'll go ahead and fire this right over to you. And then when you use it, all you have to do is change the boxes that are in yellow to whatever your inputs are. So the way that I found this very, very useful, everybody, whenever I've had that client, like you're going to have, that says, oh, I want to wait, I'll say, hey, would you mind if I walked through something with you? And we've sat down and we pulled this spreadsheet up, and then I've asked them the questions. Hey, why don't you fill this in for me? And when you let the clients drive and put those numbers in that are highlighted in yellow, and when they see what that math translates to be, it's an absolute game changer. So shoot me an email. I'll get this over to you.
Perfect. Thank you, Jason.
You betcha. Thank you.
Guys, if you have any other questions, go ahead, put them in the chat or the question and answer. I've got a couple other classes that are coming up that I'm going to kind of go through. And Jason, if there's any more questions, I mean, with your email, they probably will reach out directly.
Of course.
That was, like I said, that was great information. So a couple of CE classes that we have coming up. Make sure you guys are getting your CE credits in. You don't want to wait till last minute on these things. We've got tax code. This will give you 3 hours of legal issues, February 21st from 9 a.m. to 12 p.m. This one, I believe, is in person. So get registered. You can go to the Eventbrite link. This is over in Arrowhead. If you want the Eventbrite link sent to you directly, you can grab that as well. All of our classes are also available on our Landmark Title website. We have an events page, so you can always go to that website. You can find the links. You can get registered for all of that. And then next week, on Wednesday, so pretty much following Marketing Matters next Wednesday, stay on Zoom a little bit more and join us for a fraud class. Matt McBride is going to be coming in, and he's with the Shattuck Companies. This is our parent company, and he's going to be doing theft of cash to close by the fraudsters. So this is a really, really important topic. A lot of times, especially when I'm constantly talking about marketing, we don't think about the ins and outs and the last couple of things that really need to happen in a transaction. But the fraudsters are thinking about these things. They are waiting, they are watching, and they are getting more clever by the day. So staying up to date on what they're doing and what to look for you and your clients really is important. So I encourage you, hop on. This is a Zoom. It's at 11 a.m. So like I said, as soon as we get done with Marketing Matters next Wednesday, hop on. This information can really be the difference between you and your clients getting into a situation where they could lose everything or not. And then right after that, next Wednesday is a crazy day. We're doing Wisdom Wednesday. We're going to be doing maximizing your open house. So open houses are back. I get the question all the time, Sarah, I know it's a buyer's market. Where can I find more buyers? Well, at open houses, that's where the buyers are. So hosting an open house, but really maximizing the benefits of that open house are really important. So hop on, we're going to give you some great ideas and get you set up with your own open house items to go out there and make it happen for your business this spring. This is also going to be on Zoom, 12:30 next Wednesday. And then wrapping up the month, last day of the month, Tuesday, February 28th from 9 a.m. to 12 p.m., we've got agency law, 3 hours of it. So hop on this. Like I said, get these credits in. We offer great CE classes here at Landmark Title, and all of these classes you can register for on our website as well. And I think that's it for us today, guys. So please reach out to Jason for the Excel spreadsheet, any questions that you have, particularly if you guys are in the Prescott area. Him and his team are absolutely amazing. I've had the pleasure of coming up and doing events with them as well, and I look forward to seeing them all again soon.
Thank you.
And then, of course, thank you to our business development management team. For you Prescott folks, you're going to recognize Michelle down there in the center. She's your business development manager up there. And then here in the Valley, we've got Beth, Becky, Melinda, Mary, Patty, Cynthia, Michael, and Renee as your team down here. So any questions that you guys have, please let us know. And of course, thank you to Landmark Title for allowing us to bring you Marketing Matters every Wednesday and bring amazing guests from all over where our offices are. We have 7 here in the Valley, 1 in Prescott, like I said, 2 up in Nevada. And we're so grateful. We're grateful to have you on. Like I said, Jason, it was amazing getting the areas that we are, having you all come on and be represented. And this information was so timely. Guys, get out there with your buyers because this window is closing.
Thank you, Sarah. Thank you so much. It was a pleasure to be on. Enjoyed having a conversation. I said a lot of stuff, so if anybody has any questions, for sure, please reach out to me. I'd love to talk to you. So,
thank you, Jason. Y'all have a great day and get out there, buy and sell these homes, guys. They're going fast.